when you kind of pose a question like that, can indirect tax systems cope with the digitalisation of the global economy? What, of course, you need is somebody to propose the counter-proposition, which is that VAT systems can cope with the digitalisation of the global economy. So 5 minutes ago, Ina very kindly agreed to act, if you like, to propose that counter-proposition. Thank you, Ina. That was very kind. But why is this an issue? Patrice explained to us earlier what the Commission is doing. The proposals are being discussed and which will hopefully come into effect in very short term. But they are proposals. They set out a framework. And what I'd like to discuss over the next 45 minutes is really just to see some of the issues which underlie the kind of theoretical solutions which Member States, the Commission, and also the OECD are looking at. It's not a new subject. I've tried to list here a bit of the history, a bit of the background as to how we've got to where we are today. I put a few dots before the conference in Ottawa in 1998. Ina, I think, was there. She was only 3 years old at the time when she was at the conference in Ottawa. But really, I think it was one of the first occasions when globally countries, administrations, business has sat down together to start to address some of the consequences of the digitalisation of the global economy. The EU was perhaps in many ways very much in the forefront of trying to address some of these issues. We had the first VAT Directive in 2002, take effect in 2003, to do with electronic supplied services supplied by non-EU established suppliers. I won't read through all the history, but you can see that there's a lot going on. More and more, and the rate at which things are happening is accelerating. Patrice made the point this morning that things are happening so quickly that even decisions taken this month or non-decisions taken this month in the Council hopefully probably will be reversed beginning of next month. Even just in Europe, let's look at some of the numbers. There are 40 million businesses in Europe, 500 million residents. 16 million of those businesses have turnover of less than 5,000 euros. There are very low barriers to entry into the e-commerce world. We now have 83% of all households have internet connections, and I'm sure all these numbers have changed since this information was provided back in 2016 by our colleagues from Irish Revenue. It's worth 500 billion euros, the market, e-commerce market in the EU. What the Ottawa group said, and what's been repeated a number of times, is that there should be, from a taxation perspective, no distinction made between the real economy, bricks and mortar, shops on the high street, and the e-commerce, the internet economy. We'll see perhaps as we go through that that statement of good intent is actually quite difficult to apply in practice. Just focusing down a stage further, goods coming in from third countries into the EU. These were some numbers produced for the Fiscalis conference in Malmö, excuse the pronunciation, in April of last year. 190 million parcels, of which, surprisingly, 150 million had a declared value of less than 22 euros. There's only around 2% of all the parcels that come into the EU which are physically checked, and that mostly by the customs authorities to detect prohibited goods being imported, drugs, arms, traffic in animal products and so forth. Patrice mentioned earlier that from the Copenhagen Institute study, there were perhaps 65% of all goods being brought into the EU which were underdeclared or misdescribed. 65% of those packets misdescribed or undervalued. And when those parcels come through the postal system, not through the express carriers, but through the postal system, only about 35% of the VAT that's normally due on those goods imported into the EU is actually collected and paid. 35%. Other way around, 65% of the VAT is not being collected on parcels coming through the postal system. When the parcels come to the express carriers, there the rate of collection is nearly 100%, 98%. As Patrice mentioned also earlier, what this does, of course, is give a serious competitive disadvantage to EU businesses. How can you compete with a product coming into your territory when there is no VAT being paid at 25% if I take our colleagues in Denmark, 20% for France and so forth? You can't. You cannot compete. The estimate made was that as a result of these underdeclared, misdescribed imports coming into the EU from third countries, we all collectively in the EU are losing 5 billion euros of VAT per year. That's an estimate. My own personal view, not based on any scientific calculation, is that number is significantly understated. But going back to the Ottawa Conference in 1988, the number of guiding principles were laid down that the tax system should be neutral between the different types of business, whether it's e-commerce, non-e-commerce, conventional, and so forth. But in order to make the system work, in order to ensure that the VAT is collected, the way that the businesses have to comply must be simple. The tax rules must be certain. Tax should produce, or taxation should ensure that the right amount of tax is paid and collected at the right time, potential for evasion and avoidance minimised. And of course, tax collection systems should be sufficiently dynamic and flexible to ensure that they are able to cope with the continuing and ever increasing rapidity of changes in the way that business is done. What we are seeing, though, is that countries are reacting to the globalization of the economy, or the digitalized economy, or digitalization rather, of the global economy in different ways. We've seen recent proposals from France and Italy to introduce or to propose an equalization tax or turnover tax on large internet companies, as they were described. Now, this has got nothing to do with VAT. This is a suggestion, a proposal that's being made to find some way of taxing the profits that are made by the non-established internet companies, not established in the EU, internet companies, because it's difficult to actually identify a permanence or presence within the EU, which would be the normal way, if you like, of actually taxing some part of the profit that those entities or groups are making. So we're moving away from direct taxes to indirect tax. We're moving to a turnover tax. That's the proposal that was on the table. Now, it's not, at this stage, I don't think, going much further forward. But nonetheless, we are seeing countries undertaking reviews, looking at their own very narrow situations and coming up with proposals to introduce taxation in incredibly different ways. Other suggestions on the table: withholding tax on digital transactions, so that the customer would effectively withhold tax on the net amount, or sorry, on the transaction amount that he paid to his supplier. or a levy on the revenues that the digital services providers generate through advertising. We have that in France. It's now been extended to YouTube with effect from September of this year, whereby YouTube will now have to pay a tax in France on the advertising revenue that YouTube earns in France. Well, YouTube, they will comply. Absolutely they will comply. But how many other sites like YouTube operating in a similar way as YouTube, will they comply? Will they actually will they actually suffer the tax burden which YouTube might suffer? Will the French advertisers ensure that the right amount of tax is withheld? So we're looking on one side, what's happening in the VAT space, if I can use that expression, and the other side, we're looking at how countries are looking to see by what means they can ensure that the non-established companies pay tax on the profit revenues which they generate from doing business into those countries. OECD clearly laid down in its guidelines, its guiding principles, that VAT, GST should be taxed at the place, should be applied at the place of consumption. The destination principle, the OECD determined, is the best proxy for consumption. So we look to see where the transaction ends up, goods or services, taxation applied in those locations, because it's those locations where consumption is deemed to take place, and so on. That's fine, the principle, but how do we actually then make sure that these non-established suppliers in the country in which the taxation takes place, how do we ensure that those non-established suppliers are going to collect and remit the tax that's due on those transactions taking place in the territory where the consumption is? And that's the big challenge. Mentioned earlier, in the EU, very much in the forefront of this in terms of timing, back in 2003, first attempt to ensure that non-EU established suppliers providing electronic supplied services into the EU, subject to tax on the destination principle, would collect and remit and pay the tax that was due on the services being provided. The initial take-up of that regime was, I think, very low, and remained very low for a considerable number of years. The big operators, clearly, they complied. But the multitude, the thousands, perhaps, I don't know, millions of companies providing services over the internet, not established in the EU, how many of them registered to pay or to collect and pay VAT where the customer is located in the EU? How many of them actually did so? I think from memory, the initial take-up was something like 142 companies, 142 for the whole of the year. Next stage in the EU was the adoption of the 2008/8 Directive, which took effect from January 1, 2015, and basically changed fundamentally the place of supply of electronically supplied services. We moved away from the origin principle whereby VAT was due in the country in which the supplier was established, and we moved to a system where VAT was due in the country where the consumption took place, in the destination country. We put into place a limited revenue sharing, VAT collection revenue sharing for a transitional period, so as not to prejudice those member states which historically by application of the origin principle, had been those countries where most of the VAT was being collected. So there's a transitional regime which runs out at the end of next year. Initial success, 3 billion euros of VAT revenues were collected in the first year of operation in 2015. One of the key elements, though, as in that directive, was the absolute need to ensure that there was a far greater level of cooperation between the member states. Why? Because under the new system, a company, let's say, based in my country, in France, supplying services into the other 27 member states, is collecting the VAT of those other 27 member states. So it requires a huge amount of confidence by the other member states that France is collecting from its taxpayer in its country the right amount of VAT on behalf of the 27 others. We're not quite there yet. It's working, but it could work better. I won't go through these proposals in much detail. Patrice already covered these as to what the Commission is currently proposing, what's on the table to modernise the treatment of, or application of VAT rather, to certain cross-border transactions in goods for e-commerce purposes and also for services. Long term, the objective is to use the mini one-stop shop for supplies of goods and electronic services cross-border within the EU. So to avoid the current system, as Patrice mentioned, of companies making distant sales of goods, having to register in every member state as soon as they get over the threshold of the member state of destination. The mini one-stop shop, or the one-stop shop, will be extended so that companies established in, say, France will then file with the French tax authorities a single return listing the VAT that's due in the other probably 26 member states by the time we get to 2021. So what type of risks does e-commerce generate for tax authorities, tax administrations? Well, clearly there's a risk to the exchequer. In other words, we can't put into place, we can't find the means to enforce the legislation that we put into place, then there's clearly going to be a tax risk. There's a loss of tax revenue to governments. There's a reputational risk. I'm a taxpayer, I'm not collecting the right amount of VAT, I'm not paying the right amount of VAT to the right tax authorities. That could give me perhaps a competitive advantage. That competitive advantage might spread. So there's going to be a reputational risk both for me and also to my potential competitors. How do we go about detecting who actually is engaged in cross-border e-commerce type activities? And sometimes we've even seen, I recall a presentation that one of our colleagues from the Czech, I think it was the Czech administration, gave to us at one of the IVA conferences last year, where they'd actually looked to see who was using the mini one-stop shop in the Czech Republic for cross-border supplies of electronically supplied services. And they found that the major country that was receiving the services from the various suppliers established in the Czech Republic, I think, was Germany. So they were collecting quite a lot of German VAT. What they then identified was that the businesses concerned, or some of the businesses concerned, were completely fictitious. They didn't actually exist. They were nonetheless accounting through the Czech portal for German VAT. And they've done some more investigation in the Czech Republic, and apparently the operations were money laundering. So here was somebody, apparently it wasn't just one company, apparently a number of them doing this, established in a country, the Czech Republic, making supplies of electronic supplies services into another member state, Germany, and then paying German VAT through the Czech portal, but in reality the transactions weren't real. They didn't exist. So the middle people, they were taking a hit on their money laundering of 19% German VAT, but apparently it was still worth paying the German VAT to launder the transactions underneath. It's all moving very quickly. We've seen a number of these issues cropping up. There are new financial institutions. A couple of weeks ago, the largest telecoms operator in France became a bank. So my telephone, I'm now with Orange in France. I can now use my telephone because my telecoms operator, Orange, is now a bank. So I can do my transactions, not with my bank, my historic bank, through my telephone, but I can actually now do it through Orange. So we've got new companies entering the kind of financial services market, the banking market, who didn't exist in the past. I won't go into talking about bitcoins and things because I could talk beyond my allotted 3/4 of an hour just on bitcoins alone. There are some fraud risks. There's a significant number of abuses going on of the distance selling rules. The Commission is proposing to deal with that by modifying Article 33 of the Directive, by introducing a new Article 14.4 for definitions, modifications also to Article 35 of the Directive, because there are a lot of businesses which abuse the distance selling rules. I got one of these kind of messages the other day from a company based in one member state, which said, we see that you're interested in buying socks. I didn't know I was interested in buying socks, but apparently, from something I'd done at some point in time, somebody had identified that I was interested in buying socks. And they said, we've got this wonderful promotion on socks at the moment, here you are, you can get 50% off your socks. Okay? They said, what you want to do is you kind of click and do this, and you kind of order your socks, and they will be delivered to you in a shop in Madrid. Okay, I live in Paris, my socks were in Madrid. And they said, never mind, we know this wonderful transport company, really good, and they have very kindly, well, for a small price, arranged to pick up your socks in the shop in Madrid, and they will deliver them to you, to your house, or my flat, very, very tiny flat, in Paris. Okay, let me have a look at the invoice. They sent me the invoice. What VAT do you think was on the invoice? I'm in Paris, the socks were coming from Spain and being transported by a transport company. What VAT did I see on the invoice? Which country's VAT? Well, it wasn't Russian. I'll give you a clue. It wasn't Russian VAT. There are not that many options. I think either the member state where this company was established would be one possibility. French VAT might be another possibility because I live in France, so distance selling rules, normally you expect French VAT, or perhaps Spanish VAT. What do people think? Sorry? Paris? France? Spanish? Yeah, absolutely right. Sorry, Spanish VAT. So my wife then went on to this same shop and said, that's a great idea. Because she's quite small, my wife, she said, I'll go and buy one of my dresses from Marks and Spencer's in the UK. And this platform said, yep, fine, no problem. So she bought her dress from Marks and Spencer in the UK, no VAT at all. Because my wife benefits from the size of clothes that fit small children, even though she's not that small. The transport company said, yes, but we're going to deliver these goods to your wife from the UK. So they said, we'll have to charge you nonetheless, UK VAT on the transport. But nonetheless, my wife was able to get this dress, apparently, without any VAT on. So there are abuses of the distance selling rules. They will be dealt with, as I mentioned, by changing Article 33 in the Directive. I won't talk about fulfilment houses. The UK has had some issues with fulfilment houses, not just the UK, by the way, but I think the UK has identified some big issues with fulfilment houses. There will be some changes, I think, made in the UK next year around that. Problems of suppression of sales on distance selling. So I'll use, say, an Irish company supplying zero-rated goods into another EU member state. It doesn't declare all the level of sales made into that other member state and applies, let's say, a zero rating in Ireland because it happens to be a zero-rated product in Ireland. At the moment today, tax administrations have no way of telling, if I'm in France, how much I might have bought from the Irish supplier. And on and on and on. And I mentioned my money laundering example earlier. It is difficult for member states to devise effective responses to try and tackle and deal with these issues. And I think even when looking at what's being proposed, Patrice, I'm not sure that we've got completely there yet in all of the solutions, responses that we need to put into place to try and tackle some of these issues that I've just set out. I haven't even touched on the sharing economy. That's getting bigger by the day. Is VAT being applied? Is VAT being collected? Do we actually know where these transactions are taking place? Who's doing them for what value and so forth? In many member states, there's inadequate third-party reporting. Tax authorities cannot get the information that they need in order to ensure that the right amount of VAT is being paid at the right time. And the last line I put down there is something that's perhaps not on the table just yet, but something to think about, is this question of what I call mutual supplies. It was in the report that was produced in France back in 2012 by two gentlemen called Michel Collin and Michel Collin. They weren't the same person, they weren't brothers. The spelling of their names is actually slightly different. But they identified that there is perhaps a significant amount of VAT that's not being collected from mutual supplies. What do I mean by that? What I mean by that is I go onto a well-known internet search engine and I want to find an article about, let's say, what the Council's proposal is on VAT collection mechanisms. When I do that onto that internet search engine's platform, that internet search engine finds out things about me. They see that I'm searching for a document on the European Council. They might also see that I'm searching for a hotel. They might see whatever I'm doing. And in this report from Collin & Collin, they said, should we not therefore be taxing or subjecting to VAT the service which the internet search engine is providing to me in exchange for the data which I'm providing to that internet search engine about what I'm looking for? Now, some people have said to me, yeah, but Stephen, that will never work. You can never possibly subject to VAT that flow from that internet search engine, the service I'm getting, which I don't apparently pay for. Well, of course you can. The VAT Directive allows me to do it. It says, if I receive from a taxable person acting as such a supply of services for consideration, that supply is taxable. And it should be taxed where I am, in my destination country, so in my case, France. That's perhaps something to think about. Our colleagues from the Finnish administration gave a presentation at the IVA as to how they're going about trying to detect some people engaged in cross-border transactions where the destination country is Finland, how they can actually detect them. They have the opportunity to access banking data. They get hold of people's credit cards. They can look to see who people are paying outside Finland for buying goods and services which are then consumed in Finland. They've been very successful. I won't go into that in any detail, but they've been very successful in identifying some of these. What I did ask them, though, I said, well, okay, that's fine, but Finland is a great example of what can be done to try and identify some of these transactions. And I said to them, well, do you share what you do and how you do it with the other member states? And she said, well, no, we don't. So I said, well, wouldn't it be kind of great if all the member states together sat down and said, okay, well, let's look what Finland's doing. I know the Irish are doing quite a bit of stuff in this area as well. Let's all kind of sit down together. I was talking to an ex-colleague from the French administration yesterday who said that France is doing something similar as well, but everybody's doing it in each member state on its own. Wouldn't it be great if all 27, 28 sat down and said, hang on guys, let's look to see what processes, what procedures, what means have we got collectively to identify some of these transactions and make sure that VAT is collected and accounted for properly. We've talked about what the Commission is doing to improve collection. I won't go into that. There will be a new MOS. I think this has happened or going to happen shortly. The update of the information on the Commission's website about the VAT rates applicable, and that's just to ESS. If you look, we all thought, of course, ESS transactions were all subject to the same VAT rate. Well, actually, they're not, because it actually does depend upon what is actually being provided. So, for example, in France, we have 3 different VAT rates on electronic supply services, depending on what is actually being supplied. Again, I won't go into this. Patrice covered this earlier, where we said that the introduction of the MOS should reduce business compliance costs by 13 million euros a year, which therefore would be a greater incentive for people to perhaps comply. The couple of there's minor catching up technical issues we're catching up on to deal with slight differences in the directive. This has been dropped apparently. There was a proposal in December 2006 to change Article 28 of the Directive, which is the one that says if you intervene in supplier services, you are deemed to have acquired and resupplied those services. And the idea was to extend that notion to services being supplied through or via an interface, a portal or a telecommunications network, and make the intermediary, if you like, liable. It's already been done, as Patrice mentioned earlier, for ESS. What this would have done, of course, is extended that idea, same principle, to all the other services beyond ESS. But that's now been dropped. For goods, Patrice mentioned earlier also as well that we've now got changes being proposed to the directive. A new Article 14 for the Directive, which gives us some definitions of what we mean by EU supply and distance selling. I've already mentioned modifications of Article 33. If we look at Article 14A, this is the one that Patrice mentioned is the one which will effectively make the platforms liable by treating them as being buyers, resellers of goods brought in from third countries. And what the article says, it says, where a taxable person facilitates, through the use of an electronic interface, such as a marketplace, platform, portal, or similar means, distance sales of goods imported from third countries, third territories or third countries in consignments of an intrinsic value not exceeding €150, that taxable person, i.e. the platform, will be deemed to have received and supplied those goods. I know from the discussions that some member states have said, well, hang on a minute, how do we make a platform a taxable person? What is it? What's an electronic interface? How do we make an electronic interface a taxable person? So again, going back to my opening remarks, we've got some good principles. My concern still is, how are we going to apply this in practice? Again, the big players are going to comply. That's not an issue. And they account for, I think, David said, about 78%, 80% of total inbound flows of goods from third countries. But the smaller platforms, the smaller interfaces, the smaller marketplaces, how on earth are we going to make them comply? That's the challenge. Direct registration, that's the solution being adopted by a number of countries. Australia we talked about, New Zealand is looking at it. MOS-type systems, one country collects the tax due in lots of others and then remits that tax. We've seen that working successfully in the EU for supplies of services. Then we've got other systems, withholding systems I talked about, using the payment providers as tax collectors, the banks, the credit card companies. They collect they see the flow, the value of the transaction. They split the payment, so the goods value goes to the supplier and the VAT goes to the appropriate tax authorities. We've seen for intermediaries what's been done here in the EU. The OECD has been looking at this in some more detail and said there's perhaps two approaches that we can take here to determine where the intermediary should be treated as effectively liable for the VAT that's due. Reverse charge systems in a B2C context don't really work. You can't really make the the end customer liable to account for the VAT that's due on the transaction from a third party or a third country supplier. It just doesn't work. Nobody would ever do it. We did talk about tax representatives earlier. Ina mentioned that with Patrice, and that's perhaps something worth exploring. Here's what the OECD proposed on the Deem supplier approach, and this is effectively the solution that the EU has adopted for goods coming in from third countries. So it applies equally to goods and to services. What we are seeing, though, and my plea from a personal perspective is that we do all talk together. Otherwise, we will end up, and I think we've already identified this from one of our colleagues from IBFD earlier, that we're going to end up with piecemeal approaches. We're going to end up with a situation where different countries introduce different solutions, which means that from a global perspective, providing goods, services across borders, it just becomes an absolute nightmare. So, to conclude my remarks, my view is that VAT is probably the most effective way of taxing consumption in the digitalised global economy. Taxation taking place where consumption is, the proxy being the destination principle. But we must ensure that collection mechanisms for non-established suppliers are effective. There must be much greater cooperation starting with the EU, between the member states. There's a lot more that we could and ought to, in my view, ought to be doing. Ensure that business is involved. Now, I appreciate that there are imperatives and why taxing authorities, governments need to do things within certain time frames, but nonetheless, doing those things in isolation, in the sense of not involving business at an early enough stage, can only create problems later. Litigation, which is, of course, in nobody's interest. Perhaps we ought to think about using multiple collection systems. We need to think about thresholds. If they're too low, then businesses will stop, as we've seen earlier, trading across borders. I had a client, even just last week, said, I'm going to block my, not quite sure how, my portal, my system, so anybody from buying from outside of my country, even trying to buy from outside of my country, just can't. What a great way to do business. You're deliberately stopping doing business because he does not want to have to deal with VAT registration in 28 EU member states. And this is a big US group. Maximum use electronic filing payments. Make the rules simple. How many VAT rates do we have currently in the EU? I don't know, 84. How many do we have in France? 9. I'll explain that to you, don't worry. Information, clear, precise, in multiple languages. I know it's always a temptation to use English because perhaps it's well known, and we've seen from the Australian tax authorities roadshow recently that they are going to do that. The Commission, on its website, on ESS, I think we've got 15 languages, including EU member states, plus Chinese, Russian, and a few others as well. Refund mechanisms where VAT is incurred locally, they must operate, must be effective, refunds in time, simplified processes. But what is absolutely crucial is that both businesses and tax authorities have certainty. They know who is liable for the VAT, where and when. Any questions?